So good morning, everybody, and a very warm welcome indeed to this equity development and IPSX webinar this morning. It's a very hot morning, and we're very grateful for all of you for taking the time and joining us. And we'll run this for an hour, by which stage I'm sure that my fellow panelists will be very grateful for a break and hopefully a little cool refreshment. So my name is Kevin Marriott from IPSX, and it's my pleasure to be your host today. I think it's fair to say that just about every investor has been infected in some way or another by coronavirus. And I'm sure, as with all investors, the search for yield continues to be incredibly challenging. And I am sure this morning is going to be interesting so far as thinking about how IPSX as a new stock exchange might just be able to help in that search for yield. But before we get going and start exploring some of those thoughts and some of those ideas, let me first of all start by saying a very big thank you to our virtual host today, Equity Development, and for their help in putting together today's session. So without further ado, let's welcome our panel who are going to take us through our topics this morning. And it's my very great pleasure to introduce Roger Clark, who is Managing Director and Head of Capital Markets at IPSX, and he'll be starting the session off very shortly. It's also my great pleasure to introduce Peter O'Brien, who's also Managing Director and Head of Valuation Consultancy at Real Estate Advisors Avison Young. And to our host, Roger Leboff, who's a Senior Analyst at Equity Development, who will be speaking to us shortly after we've heard from Peter. And lastly, it's a great pleasure to have with us today Hugh Stevens from DLS Advisors, who has many, many years of experience of working in real estate and particularly in transacting and investing in real estate assets. And it's going to be great listening to what Hugh has to say a little bit later on. So this is your panel, this is your lineup. Before we make a start, let me just provide some very short housekeeping points, if I may. You can ask any questions or make any points or comments or observations as we're going along. And as is always the way with the Zoom webinars, and I'm sure all of you are very proficient with this by now, you can use the Q&A box that you will find in the bottom of your Zoom bar. I must also add that all participants are on mute, as this is the easiest way for us to be able to manage your questions and your comments. So please don't hold back as the webinar unfolds. If you have any points or any thoughts that you would like to share with us, then please do contribute through that question and answer box, and we'll use those as the session starts. So let's make a start, and to help set the scene, I'm going to invite Roger Clark, Managing Director at IPSX, to give us a bit of an update on what's been going on with IPSX as the first stock exchange for real estate, and how this is going to help investors, and particularly also what's been going on in the real estate market. So without further ado, let me introduce Roger.
Kevin, thank you, and good morning, everyone. I thought that before talking about IPSX specifically, it was worth just taking a step back and talking about real estate as an asset class and how it sits within the investment spectrum today. So Kevin, if we can have the first slide. This is a fairly familiar slide to many of you, I'm sure. It just shows the gap, the income yield premium between real estate, this is UK all property, and the 5-year sterling swap rate, which is the most appropriate financing rate for real estate. And I think what it shows very clearly is that since the GFC, the yield premium available from real estate as an asset class has stayed fairly stable and very high in historical terms. I think it's interesting as well, when you look at the grey bar on the right-hand side of this slide, you can see that we are inching upwards towards a fourth peak since the GFC. And it's worth noting that at the point of each of those last 3 peaks, listed real estate performed particularly well afterwards. People often say, you often hear people say that at the moment real estate is an uninvestable asset class because rent payments are not coming in on time, and thanks to the government, some people perceive rent payments as being almost voluntary. But the fact is, what this chart shows is that on a risk-adjusted basis, I would say that real estate has never been cheaper for investors. Kevin, if we could move on to the next slide, I just want to emphasize this point about income from real estate. This is the latest consensus forecast from the IPF. For those that don't know, the IPF is a research forum that comprises owners of real estate, investors in real estate, managers, and advisors. So this is the view from the industry. This is the inside view of what's going to happen over the next 4 years. 2020, no surprise there that capital values are expected to fall. But I would add that this is, again, a consensus across all property. Not all real estate is down 12% this year. But what I really want people to focus on is the violet part of this chart, which is showing the income returns from real estate, which are stable and 5% compared to other asset classes are really quite attractive today. Income is what you buy real estate for, asset-backed, secure income. Now, I did make the point a moment ago that some rent payments are not being paid. But let's remember that most of what you read about in the press, most of what you might see on TV is talking about retail on the high street. Retail is challenged, there's no question about that. But in the listed real estate space, retail, pure play retail amounts for less than 5% of what is available to invest in listed real estate. It is and was already pre-COVID irrelevant in listed real estate capital markets. Kevin, if we could move on to the next slide. Here, I want to just illustrate how different parts of the real estate markets have performed better than others over the last 5 years. Here, what we've done is we've categorized the listed real estate space into retail, into British Land and Land Securities, which on their own are slight sort of outliers as being very large, very diversified REITs, the London specialists, and then the long income or operational real estate plays. These are the type of things we used to call alternatives: self-storage, education, medical, residential. Now, some people sometimes point out that, well, obviously these have performed well because they are immune to stresses from COVID-19 lockdown. And that may be true. But I think what they all have in common, these well-performing areas of the real estate markets, is that they have transparent, predictable, secure, robust cash flows. In other words, going back to the point I was making earlier on, that some rent payments are not being made, actually quite a lot are. Take, for example, London office rents. At the June quarter day, 88% of London office rents were paid on time. Now, that might surprise some people. That seems slightly counterintuitive. It's only really retail and food and beverage as a part of retail that's suffering in the way that we keep reading and hearing in the media that all real estate is. Actually, if you buy the right sort of real estate with the right sort of income streams, you get good, secure, capital-backed income streams. And that's what you should buy real estate for. So real estate remains very investable and arguably very good value. And in a multi-asset portfolio, beginning to actually replace the sources of income, long-term income that you used to get from bonds. Kevin, next slide, please. Now, IPSX. What is the point of IPSX? Well, we set up IPSX with a single core vision, which was that we wanted to open up real estate as an asset class to all investors. Traditionally, real estate is quite expensive. 60% of all transactions in the UK real estate markets that take place over the last 10 years have been for assets with a value of £50 million or more, single assets, worth 50 million or more. So that's out of the reach of most investors, all but the largest institutions, sovereign funds, private equity funds, can't really buy direct real estate of the grade A commercial type that they want. And that's forced everybody below the line within this pyramid, smaller institutions, high net worth family office, private bank clients, all the way down to retail investors. It's forced them to access real estate through collective funds of one sort or another, or REITs. And we all know, it's all too well publicized time and time again, that a lot of these retail friendly funds aren't actually that friendly to retail investors. Many of them are gated again. What we want to do at IPSX, Kevin, if we could have the next slide, was to open up real estate to everybody. So we've set up a stock exchange. Our two markets, prime and wholesale, are both within a recognized investment exchange regulatory umbrella that's overseen by the FCA. It's the highest level of regulatory approval you can get. We are only the 7th RIE in the UK. We're also a recognized stock exchange for the purposes of HMRC. And that's important because it means companies that list on our markets can elect to become REITs. And that means all of the tax transparency that comes with that. Because we're a fully regulated RIE, it means shares that list on our markets are eligible to go into SIPs and ISAs, and so really are available to everyone to own in the most efficient way. We have two markets. IPSX Prime is for all investors, including retail investors. It is a regulated market, and it is designed for core plus assets, which are stabilized, low risk, income producing. Companies that list on this market will have to sell at least 25% of the shares into free float. Most will sell more than that. Because it's for stabilized assets, the leverage, the borrowing of these companies, the loan to value is limited to 40%. These companies will come to market at IPO with a prospectus, which has been pre-vetted and approved by the FCA. And importantly, referencing back the point I made earlier about certain open-ended funds being gated, importantly, liquidity is guaranteed for these shares by a quote-driven system of market making. All of these companies will have market makers. We have the likes of Peel Hunt, Pamela Gordon, WH Ireland signed up to act as market makers. And it means that you will always be able to get a two-way price at which you can trade. You can buy or sell your shares at any time you want to. That's really important, because what we're doing here is marrying the regulation, transparency, and liquidity that comes from a stock exchange with the returns and direct control that you get from buying a single piece of real estate. It's never been done before. We're the only exchange in the world that's doing this. It's really revolutionary. And Kevin, you mentioned where are we? Well, I'm pleased to say after it's taken us a long time to get our regulatory approvals in place. It's taken us a long time to build the infrastructure that a stock exchange needs. It's a very complicated process, but it's important that we've done that, because it means now we are a stock exchange just like any other. And we are about to launch. Our first IPOs are coming in September. So it's a really exciting time. Now, we do have a second market, IPSX Wholesale, which is new. And many people who may have looked at IPSX in the past who are on the webinar today might not have seen wholesale before. This only came about earlier this year. And this is a slightly different market. It's only for institutional and professional investors. And because of that, there are a number of the prescriptive rules that go with the regulated market that don't apply to this multilateral trading facility. There is no need for the assets to be income producing on day one. They don't need to be stabilized. Much higher leverage is allowed if the companies want to have that. It could be as high as 80%. To actually IPO on this exchange, you don't need a pre-approved prospectus. You just need an admission document, which is submitted to IPSX as the exchange regulator. And perhaps most interestingly, there's no prescribed minimum free float, which means that we will see assets coming onto this market which would like to be listed for various reasons, not least that they might want to enter the REIT regime, but the owners don't necessarily actually want to sell the asset. So it's an opportunity for investors to come in alongside, in many cases, some of the very largest owners of real estate in the world, in some of the largest and most trophy assets, and have the chance to co-invest alongside. It's an opportunity that's never been there before. So that's where we are. It's taken 5 years to get here, but we're about to launch our markets now, and it's a very exciting time for IPSX.
Great. Thank you very much indeed, Roger. Now, before we move on, we've already had some questions beginning to arrive. And Roger, before I go to Peter O'Brien, may I just ask you to pick up on this question that's come in whilst you've been talking? And the question is this: will this market be long only, or can it also be used to hedge?
It can be used. It won't be long only. That's not, as an exchange, it's not for us to legislate that. And indeed, in order to see proper liquidity in secondary markets, actually the ability for people to borrow shares, to short shares, is a good thing. And indeed, this might be overly technical, but one of the things we want to make sure as an exchange to assist liquidity happens is we will require issuers to put in place a stock lending facility, so that those market makers that are providing the liquidity will always know that they can go and borrow stock to deliver against trades. Now, it's a very complex part of the market, but at its simplest, what this means is, other things being equal, spreads on those quotes will be narrower, and that will assist liquidity.
Okay, very good. Thank you, Roger. So colleagues on the call, please do keep your questions and your points coming. It's great to get your interactivity. We're going to move now to, we're going to hear what Peter O'Brien has to say. Peter is, as I introduced him earlier, Managing Director and Head of Valuation Consultancy at leading real estate advisors Avison Young. And I think it's fair to say that all investors have a huge amount of interest in where value of real estate is today, and clearly where value of real estate is moving to tomorrow. And I can't think of a better person to talk to us today than Peter, who's got many, many years of experience as a valuer. And I am sure, Peter, just like every other valuer, this last few months has been a really busy time for you. How are you seeing real estate values just now?
Thank you, Kevin. I'll just say that actually a few things that I'm going to say will actually echo what Roger's just been talking about. And we've been very busy, as you've said, and I'll just take us back to March when all this erupted. So what actually happened in March, clearly it was a shock to the financial markets, but clearly it was a real shock to the real estate markets as well, when this all blew up. And so what, just to put in picture what we've been trying to wrestle with, in 2018, in Q2, there were 14 billion of transactions across all sectors. In 2019, because we had all these Brexit dates, that amounted to about 10.4 billion of transactions over that period. Same period this year is around about 5 billion. So effectively, the market had halved in a number of transactions. Why did that happen? One, it's the perceived risk of investing in this market and making big decisions about investing in real estate. Also, you couldn't actually physically go around buildings because we were all in lockdown. So the market just ceased. And clearly, if you even could go around a building, all the other sort of due diligence processes were actually in free fall. So they all completely stopped. So you couldn't run searches at the local authority. The lawyers were all working from home, all sorts of challenges that investors were faced with. So you had a market that kind of temporarily ceased. And how does the valuer value in that market? Well, it's extremely challenging. What are the challenges? Firstly, like I just mentioned, there's a lack of liquidity and a limited number of transactions on which to base your opinion of value of any particular asset. And also, that the tenants aren't paying rent. Tenants aren't fundamentally paying their rent. Not all tenants are not paying the rent, but a lot of them were delayed. And I'll come on to the rental figures. Actually, they're actually a lot better than what people think and what's being said in the press, as Roger alluded to. But those are the challenges faced by a valuer in that intervening period. And what happened over that intervening period, so over H1, if we look at the MSCI index as a measure, retail capital values have fallen 13%, offices have come off around 3.75%, industrials 2.5%, and then all property is about 6.25% over H1. You saw on Roger's slide there that there's a prediction there for the full year of overall property values falling. I can't remember what the figure was. It was about 12 or 13%. That's for the full year. Over H1, over all sectors, it's showing us about 6.25%. But what we've actually seen recently is the shock is over, and we're actually really coming out the other side of it now. So the value adjustments that are happening over the last quarter to June were a lot smaller than they were to March. So it really feels like people understand that we're coming out of it. Are we on the other side? Maybe. It remains to be seen on how this develops. But it does feel like the falls are slowing, and people are a lot more comfortable about the level of uncertainty, and this is investors, comfortable about a level of uncertainty in which we're operating. Clearly, there's a lot to be done yet between now and year end. Does this all blow up again in the winter? That's anyone's guess at the moment. But right now, it feels like we are over the worst of it, but there's a lot more to play out. And I think that, just touching on Roger's point about rent collection, clearly that's a big challenge for a valuer to make an assessment around risk on rent collection. But when we look at the numbers, the actual statistics coming out of our data, and the high level statistics are being shared amongst all the firms, and some data are freely available in the market that you can go and download. You know, according to our data, it is localized within retail and leisure, where tenants aren't paying rent. But across the other broad sectors, broadly, yes, they're down, but they're not down by a catastrophic amount. A lot of the retailers or some big retail brands can actually pay, but aren't paying, because clearly they can use that cash that they pay for rent as working capital within their businesses. So why would you pay rent? If you were an investor in that retailer, you'd say don't pay your rent on time, because why take a loan from the bank when we could use that money within the business? But they will pay their rent when we come out of this. And I've got a very large office client, let sort of office client with offices all around the country, and they're a big investor in that market and very well established, and 98% of their tenants paid their rent on time as at June. And that is completely going against the grain of what we're actually reading in the press. So when you read all those headlines of, well, no one's paying the rent on time and the rents are falling and all of that, I think it's just the press grabbing hold of that and using it to grab headlines, when in actual fact, when you look at the data, it's not as bad. One point I have had thrown at me is, well, the tenants actually renegotiated their rents now, and so that's why they're paying their rents on time. They've renegotiated rents, a half rent for the next quarter or no rent for the next quarter, and that just shows us the rent's been paid. Yes, that's probably true for a very small part of that, but looking at the rental statistics, it won't impact it overall to that extent. So I think the rental statistics really do speak for themselves, and that data, for everyone who's listening, is freely available. A large section of that data is freely available on the internet, and it's published, so you can go and have a look at that. So I think, looking at the picture going forwards, clearly there's more to come out of this. We don't know how things are going to develop between now and year end, but it does feel, and this is a true picture, it does feel like there's a hell of a lot, excuse my French, but an awful lot of pent-up demand in the market, because there's been this quiet quarter that's been there when investors haven't been able to invest because they can't go and look around buildings. That equity is still there waiting in the wings. And I think, if I'm a betting man, it will be a very, very busy final quarter, because people will be more comfortable with the restrictions and the risk within which they're operating. And they'll see it as an opportunity, because values have fallen a little bit, and therefore they know that things are going to pick up in the new year. So I'd be very keen to take questions from anybody if they have any, but I'll hand it back to you now, Kevin.
Okay, thank you very much indeed, Peter. A really interesting thoughts and reflections on where we are beginning to find the market. And is this the right time for investors to come in is going to be what I suspect one of the key questions. To our attendees, keep the chat going. Brilliant to see you all beginning to interact with the panelists. I will be coming back to these points when we have finished hearing from them. But if there is a thought or a point that you've got, please do share it. You can either use the webinar chat, quite happy to take them through that, or through the more formal question and answer box as well. Don't mind which, but we will be having time after we've heard from all of our panelists to come back to your points. So please do keep them going. Okay, let's bring in Roger Leboff, who is an analyst at Equity Developments, our host today. Roger, you've been hearing a lot here from what Roger Clark had to say about how he was seeing the markets. And we've just been hearing some fascinating thoughts there from Peter O'Brien as a valuer of assets in terms of where he sees things. So from your perspective, what's your take on where you see the markets? And then, if we can, what are your thoughts around IPSX coming in just at this time?
Well, thanks for that, Kevin. Yeah, so I'll provide a little context, hopefully not repeating this already been said. So we've had even by property sector standards, a dramatic 4 months, as some of the threats overhanging the market for decades have come to fruition much, much faster than anticipated, and transformed the sector's composition and profile, as Roger said. So we saw the panic-driven sell-off in March, strong recovery as the liquidity headed back, but not in the same places. So reinvestment refocused on a small group of companies perceived as winners. So the sector now has an unfamiliar look to any long-term watchers. So long-term leaders such as Land Securities, British Land, Hammerson, etc. slid away. Warehouse and logistics specialists like Segro, Tritax, Big Box have moved ahead. So Segro is now by far the sector's biggest company, with an 11 billion market cap, 30% premium to an 8 billion asset base. So Land Securities with a similar asset base, but a significant office and retail weighting, is now valued at 4 billion. British Land at 3 odd, both 50% discounts to NAV. Hammerson's now at well below a billion, something like 600 million, 87% below NAV. 80% share price fall since December, and of course Into doesn't exist anymore. So as Roger said, REIT investors have effectively abandoned retail property as uninvestable, rewarded focus elsewhere. So if you look at the sector now, you've got student accommodation provider Unite, which you might even imagine had a model which is vulnerable, now the third biggest component of the sector at 3.6 billion. 2 primary care providers, Assura and Primary Health, with about 2 billion each, both 30% above NEV. Big Yellow self-storage is in a similar position, something like, well, best part of 1.5 to 2 billion. Same across Europe and the US, their commercial real estate sectors have taken that kind of shape. So focus is what's been rewarded. Very positive for companies with portfolios focused on discrete sectors. Most of them have raised money, they're all bigger, valued at premiums to NAV. Indeed, the sheer amount of money invested and available shows investor appetite. Inevitably, the companies that really need the money can't get hold of any, but that's always the way. So you might say the sector is now priced rationally for what people see ahead. The prices of preferred stocks have been driven up to the point where it's arguable that investors are paying for years of future growth now. There's some nerves. Rent is a big concern. One of the things that, having lived through or covered property through maybe 4 cycles, typically you would expect interest rates to be cut, soften the blow, push people back into investing in real assets. Don't know you'll necessarily see the same sort of thing happening now. I agree, anecdotally, harder to buy real assets. That'll help when people can complete due diligence. So just the REITs may not actually offer the kind of safe income traditionally associated with the sector. You might even say you want to be short of Segro at the moment if it yields 2.3%, which is well below a traditional range for a warehouse logistics operator. Bargains, you know, if you're feeling bold, the more attraction to the companies you actually don't want to own at the moment, the office stocks, because certainly recover sharply if rents are collected faster than anticipated, because their REITs, dividends will be restored, reconfirmed. And their current valuation suggests the bad news for office stocks may already be in the price. So they could be the current recovery trade. But at the moment, you know, all the interest, all the momentum is heading towards anything which offers a very specific focus. And the more information, the more transparency you have on the strategy and on the asset class, the happier investors seem to be, which I think plays quite well to you know, what IPSX is trying to do. That's my take at the moment.
Okay, Roger, thank you very much indeed. Now, I suspect we're going to come back to a couple of those points that you were talking about there. And indeed, we've already got some chat coming in around what might be the impact to the office market as a result of COVID. And I'm sure there'll be a lot of interesting thoughts about that and how providers of office space are beginning to see a shift and a change in location and how that is then going to be driving value. So I suspect we'll be having a conversation around city centre take up versus more of the regional office market take up and how that is all going to be playing out. And if we might see some shift and some change, or is this all so short term that it's not going to really affect value that much at all? So that might be a question that we want to bring Peter in on. But before we do any of that, let's go and hear from Hugh Stevens. Now, Hugh is a professional in real estate transaction. He was head of transactions at AXA for many years, and he's also spent a bit of time at Pruchitsia, and most recently he's been advising other clients on investments in significant real estate across the UK. So here we have a practitioner amongst us who has been buying and selling real estate all of his career. Hugh, it's brilliant to have you with us this morning. Thank you so much for joining us. And I think you're going to tell us a little bit about your experiences and some anecdotes and some thoughts and some reflections on deals that you've done. And for investors out there, this is a great chance to put your thoughts forward to Hugh. So please do keep your contributions coming. We've got already quite a number, but it's always great to have more. So without further ado, Hugh, great to have you with us today. And I'm just going to bring in your first slide for you.
Thank you very much indeed, Kevin. And that's one hell of an entree. So I hope I don't disappoint everyone. Good morning, everyone. What I'd like to share with you today are a few thoughts and themes about what I think is going on in the property market. And of course, amongst all the doom and gloom about COVID, etc., the one thing I think we should all recognize about the human species is that we are incredibly adaptable. We're social creatures, and throughout all this stuff and nonsense, we will learn to live again. So undeniably, I'm an optimist. But the other thing that's important is a theme, and can we go to the slide, please, Kevin? The other thing that's important as a theme, I thought, audience, we ought to see some pictures of buildings rather than graphs. But the other thing that's important as a theme is that change is the only constant in life. I mean, that sounds a bit tautology, but it is the only constant in life. And out of every set of changed circumstances, there are opportunities. The picture that you see in front of you is the picture of the skyline of the City of London. There's a familiar building called the Cheese Grater, which has got the sloping elevation to the south. The building I'd like you to focus on is the building right next to it on the left-hand side. That's a building called 22 Bishopsgate. And that is an investment that I started when I was at AXA in 2014, and I left AXA in 2018. Now, the reason why I would like to spend some time discussing this with you is this. That building is probably worth £2.5 billion sterling. It's 1.25 million square feet of offices. It's multi-tenanted, it's freehold, but it is owned by 4 foreign investors. We've got 2 Canadian investors and you've got a French investor, and you've got a Far Eastern investor. Why am I mentioning that? Well, in many respects, this takes us back to what I think is the huge opportunity for IPSX. Because as we've heard from other contributors this morning, essentially IPSX offers the opportunity to untie the Gordian knot, which has beset the commercial property industry for many decades. And that Gordian knot is this: how do investors access commercial real estate in investable areas where there isn't a viable avenue for them to invest currently? Their only opportunity today to invest in commercial real estate in central London is either buying shares in the REITs or buying units in the insurance company unit funds. And as colleagues have mentioned, there is no other opportunity for investors to access buildings such as 22 Bishopsgate in the centre of London. IPSX provides that avenue. Most of the assets in central London are owned either by the REITs or by foreign investors, and yet they are amongst the most reliable income producing assets in the United Kingdom. One of the reasons why investors invest in London and the South East, and this is an unspoken fact, but it is a fact nevertheless, and that is that 38% of UK GDP is generated from London and the South East. Now that might change as a result of the developments post-COVID, but I think it is fair to assume, and I don't think anyone is really suggesting otherwise, but it is fair to assume that London will continue to be the economic driver of the United Kingdom. Next slide, please, Kevin. This is a picture of a building that is also in central London, and it is a development that I undertook when I was at AXA in the period just after the GFC. Now, the reason why I think this is an interesting example is this: when we commenced the development, we thought our tenant would be a lawyer or an investment bank. The building is located next to Farringdon Tube Station in an area of London called Midtown, so it's slightly west of the St Paul's Cathedral. We built it speculatively, and 3 months before completion, we got a knock on our door, metaphorically a knock on our door. We are Amazon and we want to take a lease on your building. Now, consider this. Amazon were at that stage, they weren't the Leviathan that they are today. A lot of people thought that they were just a retailer, but in many respects, Amazon, as we now know, is much more than a retailer. It's a technology business. Amazon were based in Slough, and the reason why they came knocking on our door was quite simple. They said, we can't attract and retain quality staff based out in Slough. Our staff say they want to be in central London, close to all the social facilities and access to airports and other living accommodation, which the central London transport infrastructure can provide. So we eventually let it to Amazon, and then we sold it. That building has a lease which is 15 years in duration, and it's got annual indexation in the rents, fixed annual indexation in the rents. So for an investor who wants income, and as we discussed earlier, IPSX provides the opportunity to provide resilient income from good quality tenants. We eventually sold that building, not to a UK pension fund, not to a UK REIT. We sold it to the German Doctors' Pension Fund. Now, that in itself explains some of the reasons for why international investors want to access commercial real estate in London. Predictable, rising cash flows backed by secure tenants. Imagine if that building had been launched on IPSX. That would give investors the freedom of choice to buy very specific income-producing assets in good locations backed by good tenants. Next slide, please, Kevin. Two other office buildings. I'm sorry to bore you with office buildings, but a lot of central London activity has been in the office segment, as we probably know. The building on the left is a building in King's Cross. When I acquired this building, we were the first investor, commercial investor, to buy on the regeneration project known as the King's Cross Estate. We built that project speculatively and not dissimilar to the Amazon building. This was pre-let 3 months before completion to another technology business called Google. Now, as we know, Google has, just like Amazon, grown at an exponential rate. One of the reasons why Google wanted to locate in this building, and they bought a headquarters building next door for their own development and own occupation. One of the reasons why is the same theme as the Amazon story. Google recognized that their staff wanted to be in and around central London, but by its nature being close to the King's Cross railway interchange, it provided accessibility to airports and indeed living accommodation both in and outside central London. I will tell you a little secret, it's outdated now, but our cost on that building was just under 300 million. When I left AXA in 2018, that building was valued at not far short of 650 million. That in itself explains the growth of central London values, but also the investors who own that building are also foreign investors, one French investor and one Canadian investor. Again, imagine what could have been if that building was available on IPSX.
Okay, Hugh, some fascinating stories coming out here. Did you want to finish off on your last amusing slide?
Yes, please. Thank you. Next slide, please, Kevin.
There we go.
Just to round everything off in a slightly juvenile and jokey fashion, when we bought 22 Bishopsgate, the Guardian newspaper published this cartoon, which in effect is mocking the high-rise owners of individual buildings. So that's the original artwork of that press article, and that appears on my study wall. My wife takes the mickey out of me most nights when she sees that. So thank you. I'll hand back to you, Kevin. Thank you.
Okay, thank you very much indeed, Hugh, for sharing those some of those thoughts. If I could bring the panel back, please, if you could take yourselves off mute and bring your video back in as well, that would be great. And what we're going to do is see if we can try and answer these points and questions that have been coming in whilst all of you have been speaking and presenting. So quite a morning. We've covered a whole swathe of different areas. We've heard about the new stock exchange IPSX. We've started to hear about how that's going to help investors. We've had a lot of reflection on what's going on in the markets at the moment in terms of what's driving value. We've started thinking about how property owners up until today have really been dominating the market in terms of the acquisitions they've been making, and how pension funds have been investing heavily into real estate. So lots to go at here, and I'm very pleased to say that our audience haven't let us down. Our audience have been very busy coming in with their thoughts and their observations. So first things first, Roger, I've got a couple of questions, if I may, to you first. This is from one of our attendees who wants to ask the question, why international in IPSX? What's the reason why we've got international in our name?
Well, we very much plan in due course for this to be, for the concept of the stock exchange for real estate to be spread around the world. We've started in the UK. Yeah, we are a London-based business. London has a long history of financial innovation and a very big real estate capital market. So it follows that that's where we started. But in very short order, we will be opening an exchange in the Eurozone. And we're already thinking about Asia as well. And we're in early stage discussions with potential partners to do something in North America. So we will be international.
Okay, very good. And if I could keep with you, Roger, for a moment or two, please. There's another question here, which I think you can deal with quite quickly. And that's from one of our audience who's just wanted to understand a little bit more about what you meant about free float. And I think this is where you were beginning to explain the difference between wholesale and prime. Could you just clarify what we mean by the free float and what that looks like for both markets?
The free float is a term that captures the shares held by the wider market. And of course, the reason that's relevant is it's worth pointing out that when you sell a building on IPSX that you don't necessarily want to sell 100% of, the whole building goes into a corporate holding structure, a single purpose vehicle. And if you wanted to retain 75% of the value of the building, you put the whole building into the company, and you now would own 75% of the shares in that company that owns the building. The 25% that you don't own is what's called the free float.
Okay, great. Thank you very much for clarifying that. I'm just now going to come back to Roger Leboeuf and to Peter O'Brien. A couple of points here for you, if I may. And I'm going to just read this point out because it's probably slightly easier if I do that. Indeed, Roger Clark, you might want to come into this as well. So let me just read this point out. Both Rogers referred to inevitable change in how property assets are now being valued. With transparency and reliability of cash flow now to the fore, is Peter seeing this already being reflected in pricing of recent commercial transactions? So let's start the conversation on this point of value with you, Peter, and then I'm going to go to Roger Leboeuf for his comments on that, and lastly to Roger Clark, and finally to Hugh. So Peter, would you like to kick us off on that?
Yeah, thank you. I mean, the cash flow from a real estate investment is always the key focus in any appraisal of any transaction. So that, that's always of paramount importance, and the transparency of that cash flow. I think, and both Rogers, correct me if I'm wrong. I think what you're referring to is when with a listing, you will need transparency of that cash flow to gain certainty around pricing of shares, as opposed to the valuation of an asset and how it's priced for a real estate transaction. So it's more the transparency of that cash flow, where it's being generated, how it's being generated, the security of that cash flow, as opposed to anybody buying an asset, changing the due diligence process they used to follow in focusing on that cash flow more, because I think that the way people buy and sell assets is relatively the same now as it has always been, with a key focus on cash flow generation.
Okay.
Am I wrong, Roger?
Let's bring in Roger Clark on that. Roger, this has been a topic of much conversation, hasn't it, on a lot of our webinars, where we've started getting into more of an understanding about how we're seeing this valuation principles being applied.
Yeah, I mean, look, to answer it as briefly as I can, when someone, picking up on what Roger was saying earlier on, when someone buys shares in Segro that are yielding 2.3%, they're not sitting there, I would say, they're not sitting there saying, I think these assets worth 8 billion will be worth 11 billion in a year's time. They're sitting there saying, from this very secure company that produces very secure cash flows, my required return on these financial instruments is 2.3%. They're not thinking about the value of the property. They're thinking about the security of the cash flows.
Yeah. Yeah. Okay. Let's go back into Roger Leboeuf. Have you got any further thoughts on that, Roger?
No, I mean, as far as commercial transactions, properties changing hands, you know, that will filter through, and I'll start to pick up on that as the leaders start to report results. But I think that if you look over time, certainly over the last 10 years, there's been an increased focus on whether the rents will be paid in a way that certainly wasn't true for the previous 20 years, where there was a presumption that, you know, they'd been well enough let. So you look at them now and you say, well, I mean, the other day, one of the primary care property owners reported, you know, there you've got 90-something% of all their rents effectively being paid by the government, the rest by pharmacies. So at least you can put a tick in that box and say, okay, well, the one thing we don't have to worry about is the rent being paid.
Mm.
And as you come down that scale towards companies, obviously the most extreme end is the retail owners. Yeah, so you'd absolutely have a look at what people are expecting to get in terms of yield to attract them. And in terms of the retail owners, there's almost nothing that they'll be prepared to take. So
Okay.
yeah, I think it's definitely.
Yeah. And finally, let's hear what Hugh has to say. Hugh, when you're looking at your past and indeed your current transactional activity and thinking about the investments you've made, where are you with this piece on valuation? What is it that you really look at?
Okay, let me answer the question in a slightly different way, Kevin, and let's just set the scene. There is no shortage of global capital to invest in real estate. That's point number one. Point number two is real estate is an essential component of any multi-asset portfolio. Point number three, in a world where you've got zero interest rates, if you've got a well-let property, let to a good tenant, a good long lease, good cash flow, in a good location, there is absolutely no shortage of investor appetite.
Mm.
Whether that comes from the Far East, the Middle East, domestically, or indeed America.
Mm.
Where I think we're seeing some disparity in transactional evidence is where you've got a good let property, and essentially investors are playing the arbitrage between the property yield and alternative long-dated income returns. And the amount of investor appetite for those types of assets is enormous.
Mm.
There was one property sold recently in London where they had 10 bids, and it went at higher than asking price.
Okay.
At the other end of the spectrum, you've got assets where you've got shorter leases and more prone to exposure to the volatility in the occupational market. And the investor demand for that is not as strong as it would be.
Okay.
So that's answering it in a slightly different way.
No, very happy to have the contribution. Let me go now to Roger Clark, if I may. I've got a technical question here for you, Roger. What are the requirements of the two markets with regards for companies to retain a sponsor, broker, stroke nomad?
So our equivalent at IPSX we call a lead advisor. This is the advisor that essentially holds the hand of the issuer through the IPO process, a bit like a sponsor on a main market listing or a nomad or name. And they have to do that for the course of the transaction. There is no requirement to retain a lead advisor on an ongoing basis. I expect people will want to keep the help of a corporate broker going forwards to engage with the stock market, but there's no formal requirement to retain a lead advisor on IPSX Prime. On IPSX Wholesale, if a cornerstone investor retains a shareholding of more than 10%, and as I mentioned, in many cases they might, then they do need to retain the services of something called a wholesale broker to allow them to provide and source the liquidity of their shares. But there's no equivalent of the ongoing retained sponsor or nomad rule.
Okay, thank you very much for clearing that point up. Now, Panel, I've got one more broader based question here. And again, I'll read it out for you, and then perhaps one of you would like to comment on it. Let me read the question. With the staggering growth in defined contribution pension schemes, 12 million individuals and growing, is IPSX the only piece of capital markets infrastructure to offer daily liquidity in single real estate assets? And I guess where this question starts to take us is the whole problem and issue that we've been seeing around funds, closed funds, what's been going on there, and all the other issues that we've been seeing.
I mean, it's a good question. As we know, most, if not all, companies have closed the traditional defined benefit schemes. There's no such thing now. Many of those are now largely in runoff. Everybody who's working today, who's contributing to a pension, it's into a contribution scheme. And they have largely had to leave real estate and private equity aside. And, you know, you talk to the people who advise and manage these funds, and they often are rueful about the illiquidity premium that is being harvested by big private equity managers like Brookfield and Blackstone. Just to put some other statistics around it, which are staggering, and I think for our asset class quite exciting. Today, defined contribution schemes have around 6 billion in the UK invested in real estate, and it's all in REITs. It has to be, because these funds have to have daily pricing and liquidity. They have to. But with the growth in participants in these schemes, over the next 15 years, their industry trade body forecasts that 6 billion needs to rise to 64 billion.
Wow.
So it's a huge prize for our asset class, our sector, to go for, and they must have daily pricing, but they don't want the opacity and the wider equity market volatility that comes with just investing in big REITs. They want to pick buildings, they want to buy real estate, but they need daily pricing for it. So yeah, to answer the question, is IPSX the only sort of perfect venue for them to get what they really want? It is, yeah.
Great. Okay, panel, look, we're closing in on our final few minutes, and what I would like to do, please, is come to each of you for your closing thoughts. And you could take this in any direction you want. You could be reflecting on the session this morning. You could be reflecting on what you see is happening in the market today, how you see things changing in the future. Closing thoughts. I'm going to start, if I may, first of all, with Peter O'Brien, and then I am going to move to Hugh Stevens, and penultimately to Roger Leboff, and then I'm going to ask Roger Clark to close the session for us today. So, Peter, I hope I've given you enough notice just to give us your thoughts and your closing remarks.
Yeah, thank you very much. I think my closing remarks would be, as you know, and some of the panelists know, we have been involved in some of the underlying real estate assets that you are proposing to list at the moment. And from what I've seen from those assets and the quality of those assets and the quality of the income return from those assets, that it's going to be a really exciting time. And I can't wait to see those go to fruition and actually be listed on the stock exchange. I think it is a really exciting time at this moment, because we've been sort of following this for very long, and all of a sudden we are now on the cusp of the moment when we actually see those listed. So I think it's a really exciting time, and something that the whole market, certainly on the real estate side, is watching to see how this develops. So thank you.
Thank you, Peter. Okay, let's go to Hugh for your thoughts, your final remarks.
Thank you, Kevin. On a similar vein, I think we should all be optimistic for the future. I know life might seem a bit dark currently, but the sun is shining and the temperature is warm. So let's stay optimistic. But also, I think given the way in which investors are trying to access commercial real estate and focus on income, IPSX genuinely provides that platform where currently investors abroad don't.
Okay, thank you very much, Hugh. Let's go to Roger Leboff. A fascinating morning, Roger.
Yes. I mean, my thought, this has typically been the stage in the cycle when you you've been best rewarded over time. You know, I think I said to you the other day, this might be my 5th property cycle, and so you know, this is the time when investor appetite should be you know, certainly, and is there, and I think that people will look for assets where there's far less opacity. I mean, the REIT started that process, but the idea that you'll be able to drill down and get some answers to those questions regarding the natures of leases and tenancies and terms and so on for specific buildings, I think that's really very interesting. So yeah, I think this is definitely something unique. Not something I haven't come across in the 30, 40 years that I've been covering property.
Yep, the stock exchanges don't launch too often, do they? Well, that's a perfect way of going to Roger Clark to close the session today.
Well, as we said earlier on, it's an exciting time. Our vision here is to try and bring all of the benefits of a stock exchange to an asset class that has hitherto been illiquid, large, and only really available to the select few. If we can give listed, regulated, liquid shares to people and get the returns of owning buildings, then we really will have done something quite revolutionary. And it's happening in September. So everybody keep an eye out, because we're launching for real in September.
Okay, thank you very much indeed. Yes, do please keep an eye out on our website, IPSX.com, where of course you can find lots of other webinars and other content that we've been busy producing and will continue to be produced as we build up to our first IPO, which, as Roger Clark was just mentioning, is looking towards that September timeframe. It's a truly tremendously exciting time, and we're very, very pleased that all of you hung on in such hot conditions to join the session today. I'm sorry that we didn't quite get round to answering everybody's questions, but we do have your contact details here. So we will be in touch with those that have asked questions through an email follow-up. It just leaves me to say thank you very much to our panel, to Hugh Stevens, to Roger Leboeuf, to Peter O'Brien, and of course to Roger Clark, and to thank all of you for joining us today. And I wish you all a very a pleasurable and enjoyable Friday, and of course the weekend when it arrives. So thank you once again for joining us, and goodbye.